Barbara Rose Alietti. I'm the Associate Dean of Communications and External Relations at the Lubin School of Business, and it's my pleasure to welcome you here to our Executives and Residence Lecture. For those of you who are unfamiliar with the program, we've had this program at Lubin for over 20 years, and we bring senior executives from various industries to campus for a day to lecture to students and interact with students and faculty. One of the key strengths of the Lubin School is the application of theory, practical application of theory. And we believe that this program is really one of the cornerstones of that thinking. Today we have a very special executive with us. Maria Fiorini Ramirez is President and Chief Executive Officer of Maria Fiorini Ramirez, MFR, which offers global economic consulting and investment advisory services to domestic and international clients and manages 3 global open-end mutual funds, in addition to investment portfolios for corporate clients. MFR's views and commentary on the world's financial markets are closely followed in the U.S. and abroad. Mrs. Ramirez's assessment of the interaction between economic, policy, and political trends and their effect on investments has led to worldwide recognition of the firm in financial banking and economic circles. She is a sought-after speaker at U.S. and international forums, a frequent guest on business-related television and radio programs, and a regular contributor to U.S. and foreign business publications. Mrs. Ramirez began her career in 1968 with American Express. She subsequently served as Vice President and Senior Money Market Economist for Merrill Lynch, Senior Vice President and Money Market Economist at Becker Paribas, and Managing Director and Money Market Economist for Drexel, before founding her own consulting firm in 1990. And as she said earlier at our lunch, she started her own firm. She'll tell you herself, because everybody else went out of business. A member of many professional organizations and boards, Mrs. Ramirez holds a BA in Business Administration and Economics from Pace University, where she also has pursued postgraduate studies. She is a member of the Lubin Advisory Board and the Pace Board of Trustees. She has been a frequent, and I might add, delightful speaker over the 9 years that I have been knowing her at Pace, and I certainly hope she has a glimmer of hope for us today about the economic outlook. So please help me welcome Maria Fiorini Ramirez.
Hello everyone, it's nice to be here in this beautiful campus. It looks like where I live, so it feels very much like home. Barbara gave a nice introduction. Thank you so much. And Barbara asked me to give you like a little talk about what's going on in the economy. So, or whatever it is that I think is interesting. Anyway, I sent to her last week what we do on a monthly basis for our clients, and she said, this thing doesn't sound too good at the end. Can you put like a positive spin to it? So I think what I'm going to try to do today is give you some glimmer of what positive things could come out of sort of the challenging environment that we're in today. But just to give you a little bit of my background, as Barbara said, I went to Pace on my undergraduate school and was on the graduate side. I worked, like many of you probably do, full-time. And what I try to learn in school is try to apply it during the day while I was working. It didn't necessarily work out in the first job or the first thing that I was doing, but I kept on trying to get to a point where I was doing what I really loved to do. And the work seemed to be more like a hobby. So I think I'm at the point in my life where I would do what I'm doing for nothing. But I certainly know what I tell my clients. But I think that you should all aim for that. You're young and energetic, and I think that maybe the environment that we're in right now doesn't look like a great one to find great financial opportunities and a job in. But definitely it's one that when I started working in the late 60s, I remember the first job I had, I sort of worked really hard at it. In like 1970, 71, the boss that I had, he waited and waited to give me a raise, and then he told me we have wage and price controls, so we can't give you a raise. I said, you waited 6 months until we got the wage and price control so that you can give me a raise. I said, thank you very much. So I asked for a transfer and I got a promotion. But anyway, I've gone through these challenging economic times in my working career many times. But I always found that those difficult times really presented themselves as good opportunities to do something else, or think about doing something else, or in the last case, where the company that I worked for, Drugs Alberta, went out of business, go on my own because I was so fed up, working for firms that went out of business, where I have really no control as to, what happens at the end. But I always thought that, you need to have portable skills, you need to have a lot of courage, a lot of guts sometimes, to take on an opportunity where you have no income for a while, but you're paying salaries, and then in the long run, hope that it sort of works out. But I think that whenever there are problems and challenges, there are really great opportunities. And I think if you sit through whatever is going on right now, as the world of financial markets is changing in front of us, it also presents itself with a lot of opportunities. So I'm going to talk a little bit about what we do. Basically, I was always an economist in what some of you know as a trading room, trying to figure out what was going on in the economic numbers and put that into what it meant for the market. And the people that I usually work for didn't want to have an academic kind of, story. They wanted to know whether they should buy or sell, and they wanted to know immediately. So I think I sharpened my tools a little bit in that I had to know how to deduct a lot of information and make it into a plain answer, which was yes or no, or buy or sell, or something like that. And I had to be able to live with it. And that if it was wrong, I would be the first one to say, I'm sorry, I hope you didn't lose a lot of money. If it was good, I knew that I wasn't going to get the rewards for it, but I kept on reminding them that I did something good. So it usually sort of worked out in the long run. But I do think that, you sort of develop a lot of skills in school and in the things that you're learning, but then I think you have to fine-tune them as the environment around you changes, and the environment is sort of changing right now. So when I started my business, basically I did a marketing study. I called 5 of my best friends that used to like what I did, and I asked them if they would pay for it. And since all of them said that they would pay for it, but I did not want to charge it, I thought it was enough of a marketing study to start your business with. So I always thought that if you have one client, somebody that's willing to pay for whatever services you're able to provide them, then it's a business. So to the point that I asked 5 people, and all of them said that they thought I should start my business around what I knew how to do. I thought it was a good thing to do. Then of course, the rest changes. So we talked earlier about the great opportunities right now in the marketplace, and we have a research business. We provide advice all over the world to financial institutions, but also we have a brokerage firm, and we do fixed income business. And given the numbers that the Treasury is using these days and spending, half a trillion here, half a trillion there, another half a trillion some other place, you're talking about a couple of trillions already, and they're going to finance that by issuing debt. So great opportunities for the next number of years in anyone that's involved in the facilitating of that debt that's going to be issued and bought and sold over the years ahead. It was really interesting that 7 or 8 years ago, when we had a surplus and thought the markets are dead, all the debt is being paid back, and there was no room for anyone in that business to survive. Now, of course, all that is back in style, and that there is a lot of debt that's going to be issued, and a lot of it is going to be financed domestically and overseas, and a lot of intermediaries with a lot of talent needed to restructure some of the problems that we have. So just think of when things are really expensive, people want to go when prices are going up, and now everything is sold at a discount, so there is a lot of opportunities to find good values in them. So I think, with this, I don't know, we have quite a bit of time, I think, right, an hour or so. I like to make this sort of an interactive thing, and whatever questions you have, or whatever things might be on your mind that I could address and maybe share my thoughts about. I'd like to spend a little bit more time doing that. But what I'm going to do is just spend a little time now in talking a little bit about sort of general economic outlook. And truthfully, we've been sort of changing this a little bit more cautiously, pushing things a little further down in terms of a recovery. I think that a couple of years ago, We have some concerns about credit being too generous and being given out too generously without, sort of digging into things. But at that time, really, nobody would listen to it. I speak a lot at the New York Community Bankers or all the kind of forums where there are a lot of bankers. And I think at that time, even though some of the regulators pointed out that some products that were being sold in the marketplace were not the right products, nobody really listened to it because there was a lot of money that was being made on that. Now, of course, things are back to square one on fundamentals. And when I started out in the business, I started out as a credit analyst. And the way I was taught, and the man that taught me, just got his phone number, it was American Express, he's 83, I'm going to get together with him, still healthy and going strong. He always told me that all credits are bad until you get your money back. So it's like ingrained in my mind that no matter what kind of modeling you use, if somebody doesn't have a job, doesn't have an income, the likelihood of getting paid back is not very high. So when you're lending money and you're in that business of investing in credit instruments, you better know where there is, because all the modeling that you do, it's only as good as your actual borrowers. And I think in the business, we're sort of going back to basics a little bit, and I think that's what the economy is going to be adjusting to, going back to basics. Anyway, a little bit about our outlook. What has brought us here? I mean, we had this subprime mortgage crisis a couple of years ago. The first headlines was actually January 7th, 2007. And I remember that because it was the day where HSBC, one of the world's largest banks, announced that they had to write off about $11 billion in subprime mortgages. And of course, you know how the media is. It's a new word, start harping on, digging into it. And before you know that one announcement was followed by many others, and in June of that year, there was a hedge fund that blew up in August of 2007. They realized that there was this thing as asset-backed commercial paper that were off the balance sheets overseas called the SIVs, Special Investment Vehicles, and there was about 60 billion in that initially blew up, but then there was another 100 billion behind it. And in my mind was, well, wait till they get to these CTOs and CPOs and all these other lingo words that nobody really knew a lot about at that time and how big they are. Well, lo and behold, several quarters, one after another, and several announcements of 10 billion losses here, 10 billion losses there, and a trillion here, a trillion there. We have some real numbers that we're dealing with now. But anyway, we became the subprime crisis. It became a full-blown meltdown, and of course, all the things that worked together on the upside for many years to fuel the excessive debt that was created, the asset price bubble that we got. Basically, it was unsustainable economic activity that now is reversed. So now, income, cash flows, I think everything is getting squeezed on the consumer side, and you see, what's happening on the numbers that come out on a day-to-day basis. But there are basically, two alternatives to remedy the situation. First, what is our politically and socially unpalatable, which should be a multi-year massive restructuring to reduce the debt levels, which would entail severe economic pain. And the second, of course, would be a monetization of the massive increase in the federal debt required to prevent economic and financial collapse. I think that with this, the long-run inflationary pressures will reduce income and cash flows sufficient to allow the debt to be serviced with the base dollar. But I don't think we're at a point yet of making either one of these choices. I think that we're inclined to first trying to stabilize the financial system and then sort of take it from there. But the corrective process is going to take a long time, and I think that it has somewhat begun already. But I think basically it boils down to a very simple thing: consuming less and saving more. And it's very hard to save more when income is not growing. So the pain certainly is going to be on the consumer spending side. Consumer spending has been the bulk of GDP growth, not only in the U.S. but in other parts of the world. But to the extent that we were running a very, very large trade deficit for many years. I think certainly the ripple effect is the pain on the countries that were running a surplus against the U.S. and their manufacturing and their employment and the income in those countries certainly is going to see the effect of this decline in consumer spending and saving. So I think that we're looking for some bounce in the economy at some point later this year or next year, or at least a stable period. But I think the key is, as the question was raised lunchtime, is really stabilizing the job market. The employment numbers, as you know, in the last few months has been awful numbers. I think only to the extent that we could stabilize the employment front can we really see an economy that levels off and starts doing better. All the credit issues and those financial related impact on the consumer is still very key. But we know that there's some progress taking place in the front, and it's going to take time for it to work itself out. This is a little bit of a forecast. The number I don't want to really spend too much time on it because the numbers are only as good as the ink is dry, and you have to change them again. But now, of course, it's easier to change them. Doesn't have to get dry. But I think the bottom line is that we look for consumer demand on the domestic side to be quite negative in the next couple of quarters. And capital spending, there's very little credit to go around, so capital spending probably continues to retrench. I guess the good sign is inflation numbers have certainly have been coming down quite a bit, and we don't expect it to come up. The consumer price index actually is probably going to be on the negative side this year as well as next year. And the core numbers, of course, are also on the negative side. I mean, it's very difficult to raise prices when consumer spending is going down. So I think it's really more squeeze on earnings that you can get. But housing, of course, has been coming down for 2 years already. We expect some leveling off, but I think the big problem with housing is really getting rid of not only the excess inventory, which I think for the most part has happened already in terms of new housing that have been put together that remain unsold, but now I think it's really recycling what you have that's existing, that's either in a foreclosure pipeline or the equity has been pretty much eroded, and you sort of have to clear that inventory at some level or others. Now, of course, car sales, we all know about what's happening in the automotive industry, but there are more rebates going on, and hopefully at some point car sales also stabilize around the 9 million level. Okay, so big picture. What has happened? I think that the bottom line, as I mentioned before, is that we have too much debt relative to the size of the U.S. economy, and there is not enough income to support this debt. I think that the process of leveraging took many years, and the process of deleveraging also, unfortunately, takes some years also, hopefully a lot less than the years it took to create it, to clean it up. But this process has basically begun about in the last year or so. I think if you look back, and we have some charts I'd like to go through in a few minutes, in the early 80s, the savings rate actually began to come down quite a bit, and consumer spending began to rise, and now we're in sort of the opposite trend, where the savings rate is likely to go up, and spending, of course, is going down. I think the way credit became so plentiful and as the price of inflation, both in financial and real estate, was because there was this mechanism in the marketplace with securitization. A lot of those assets were securitized and sold to investors that create this huge pipeline and funnel of credit to be created. At the same time, as interest rates were low, there was an appetite for investors to buy things that had a spread of a treasury or the lowest rate of financing. And I think that that process, just as it took many years to build up, about 15 years or so, it's in the process of unwinding and becoming leaner. And of course, less leverage is always a lot more painful than when you're in the process of creating the leverage. I think that the asset prices have been deflating, of course. Retirement savings have been vaporized pretty much. Home prices are down, and the idea of using the home as to borrow equity against, or in the old days it used to be called a few years ago the ATM machine, that was forced in a lot of consumer spending up, is no longer there. Credit, of course, as you know, is tight, and we have seen the problems on the banking side in terms of housing. We've seen it in the automotive sector, we've seen it in credit cards, and I think it's going to be very difficult for the people that we're creating those instruments to come back and start anytime soon. And that's where the opportunities, I think, are going to be in the next few years. I think that there is credit being made available. We were talking to one of the suppliers, the Chrysler, back in December, a friend of ours for a business in Cleveland. Well, there is credit available. Unfortunately, it's at 18%. So I think it's all a matter of how desperately you need it and when you're willing to put up with it. I think this guy that we know bought a business that was waiting for the money on December 26th from Chrysler. All these suppliers were going to force Chrysler into bankruptcy unless they got the money right after Christmas. Well, the bottom line is that they needed money to finance their payroll, and there are people out there that non-regulated financial institutions that if you put up your house and your mortgage and whatever you own, they're willing to lend you money. Unfortunately, it costs a lot, but fortunately for them, as they got the money from Chrysler, they were able to repay that loan. So there is quite a spreading out in terms of where money is and where money is willing to go. And what people paid for a few years ago, decent people will pay a small spread or whatever the prime rate was. And of course, it's double or triple as much. So balance sheets are in the process of cleaning themselves up after a period of overextension of credit. When there was a credit limit, you need to do that. But I think that, as I mentioned before, more current income is going to go into savings. So the savings rates most rise, and consumption, of course, is going to decline as a share of GDP. And this certainly is going to weigh a lot over economic growth over the next few years. A little bit about numbers here, but the total credit market debt that we have, that you could put sort of a number that seems to stick on, is about 49 trillion, and of course the GDP is about 14 trillion, the last quarterly number. So you could see here that 350% or so of debt to GDP certainly is a heavy burden to shoulder for a long period of time. I took this chart. I think I sent it out in Word so that if you guys like to have these charts and use them for something else, maybe one of the papers you're working on, you're more than welcome to. Lots of data that we put together over the years here. This is a little bit about debt explosion that we got over the years. Those same numbers are pretty much in the chart form. And this is a debt, household debt relative to asset. I think that you saw the numbers in different ways, but basically as a value of assets in real assets and financial assets like homes and investment accounts decline, certainly the balance sheet of the individual becomes more stressed, and when you add to that the leveraging consequence that you end up having, certainly it doesn't reverse itself overnight. The process has just started. What a bit more about real estate decline. Okay. I think that we all know a few months ago, I think that the National Bureau of Economic Research stated that the recession started in December of 2007. Well, I think that, if you have been in the financial business, you pretty much knew that it started before that, when the problems really started coming out in the middle of 2007. Where we are right now is that job losses in the last 4 months have been accelerating. Consumers pretty much on the siege. Capital spending has declined sharply. Housing activity, of course, has continued to decline. And export demand, as I mentioned before, is shrinking quite a bit, which is one of the reasons why some of the big exporters to the U.S. are also having their own recession. Credit is tight and is showing no signs of easing. I do think that the fiscal stimulus certainly will prevent some cuts in spending at the state and local level as the money is funneled out. I think it's going to be interesting to see how some states use the money for infrastructure or real capital spending, or whether they use the money to just fix up the deficit that they have. And I think that 45 states right now are running a deficit. I think that the latest numbers are Chicago Fed national activity, coming down quite a bit. I think that some numbers came out today, pretty much indicating the same thing. One interesting, point in the marketplace that you see every day is risk spreads all the way up. Treasury debt is yielding vis-a-vis corporate debt in terms of different qualities of corporate debt. Now, mind you, that with this, the rating agencies certainly have lost some credibility in terms of their ability to properly assess credit risk and give a proper credit rating. But needless to say, in the marketplace, people still look at it. I'm not sure whether they pay as much attention as they used to, but this morning I saw some corporate bond paper on what it was selling at. And I think that, if you're in the financial industry and it's not government guaranteed by the FDIC, like all these new issues they've been doing lately, well, you're paying double digit. It could be lower double digit or higher double digit. But if you're government guaranteed, then it's a totally different story. So historically, spreads used to tell us something, but these days they don't tell us as much because everything is driven by whether the debt that you issue is government guaranteed or not. So spreads are all over the place. Leading indicators, of course, they've been into recession territory for a while. I think that basically on the manufacturing side, there is very little activity taking place. So I wanted to talk a little bit about the labor market. I mentioned before that without income, without the labor market sort of stabilizing, it's really hard to see the economy turning around. And these pretty much are what's been going on the job front in the last few months. I think we've had a couple of months of a job decline, like over 500,000. The numbers actually were revised even downward for the previous month, but we have never seen anything like this before. And I think that if you go back into history, the consolidation, especially of the job losses in the financial markets, we've never seen anything like this before. No matter what numbers, I think you'll look at. So I think that certainly some cities are going to be affected more than others. New York, of course, being a financial center, and London, and other cities around the world where there's a large financial sector, see more of the decline. I think the numbers that I saw in the last couple of weeks or so in New York, I think the state controller was talking about job losses in New York, something about 200,000. I think that a lot of it is in the works, or has been announced already, or is taking place already. The thing is, with some of the ripple effect of those numbers and those announcements, even though people that were laid off, they were paid for a year or 6 months, and they got benefits for that period of time, they don't necessarily show up in these figures. It takes a while for them to show up in the numbers. Anyway, with the tighter credit conditions, and of course the job market the way it is, and small companies not having access to credit, it's a major blow to the labor market. That's why I think that the unemployment rate, I think people have been talking about, some cities getting worse than others, but we wouldn't be surprised if the unemployment rate keeps on creeping up another 1.5% to 2%, or maybe even as high as 10%. Last week I was listening to someone in Brooklyn that talked about the diversity of the unemployment rate, how unskilled workers are having a much tougher time keeping the jobs, or actually getting in the job market. So it's going to all come into, I think, what skills you have and how you're able to place yourself in the environment that you're in. I talked a little bit about car sales, and you can see here the numbers are really dropping sharply. Talking to one of the relatives over the weekend, he just bought a Mazda. I think he got a $3,000 rebate. He's getting a tax credit, everything else that goes with it. My brother bought a car 3 weeks ago. He didn't get anything with it. So even buying a car, it's all a matter of timing. So I think certainly, you know, the federal government is trying to do everything they can. They're trying to help the automotive industry, and it is trying to do everything to help itself to survive this turmoil that we're in. This is on the home builders front. I mentioned a little bit about housing, but we haven't really seen, you know, any turnaround on that front yet. I think, you know, some cities certainly have a little bit more access than others. I guess the good thing about New York City is we were blessed with not having a lot of land. If we had a lot of land, we would have had a lot of speculative building. But, you know, we didn't have, you know, as much speculative building as some states like Florida, California, or Arizona, where there was a lot of land to, you know, build things in. And of course, a lot of those things are empty. And, you know, housing prices in some of those communities have gone down a lot more. Housing bubble was unprecedented. You've probably seen something like this before. This goes back to, I think, 1890 or something like that. Just to give you a little bit of dimension, you know, what has happened in the last 10 years is, you know, home prices went up, you know, quite sharply. And, you know, the old saying is what goes up must come down. Well, just so it doesn't come down as much as it went up. But the start there is like November 2008. And pretty much you can see it that the prices have come down at least, you know, 30–40%. I think since then it's been even more so. And I think the next chart shows more recent numbers in January as they continue to decline. So if you go back and forth, you know, they've come down a good part of the way, but they haven't really found the bottom yet. And I think that what we're trying to do, I think, from the policies that we're seeing in Washington, is create some stability on the values of homes, because after all, a few years ago, the home was the biggest asset that an individual had, and I think it's really crucial that you find some leveling off of the values of this asset. New orders, I mentioned a little bit of manufacturing, the new orders for capital spending suggest that, you know, there are no new orders going through. The Fed, of course, its recent surveys tells us something that we know all along, that tight lending standards for commercial and industrial loans continue, and not a single bank reported any easing of standards. Now, as someone who may know Barbara knows, I've been on the board of a bank for 20 years. First in 1989, it was a small savings bank in New Jersey. And right after I got on the board in 1990, we had this huge blow up in real estate. And basically the regulators came in and told us that anything that we had in real estate, we had to write it off because all the loans were considered bad loans because real estate was bad assets. And any investments that we had in high yield bonds, we had to write it off because they were all bad investments. And of course, they increased capital requirements. Basically overnight, the whole landscape changed and many banks became insolvent because that's sort of, you know, what happens. You know, you run your business a certain way, and then when the laws change in the middle of the game, and you have to change your business to get rid of assets when nobody wants them, it's a tough thing to do. So we're going to go through the same thing right now. So they're running these stress tests, and I was reading American Banker on the way here about maybe the banks have to get the values of the real estate they have reassessed. That's like the dumbest thing to do right now. How can you reassess something when there is no buying for it? So to the extent that they actually carry that out, it will destroy more capital, it will destroy more value that you have in terms of what these banks and these financial institutions are worth. And you know, my husband said to me in 1990, he goes, why in the heck you got on the board of a bank? You know, we're going to get sued and we're going to go to jail. And I said, well, you know what? If I get off the board, we're going to get sued anyway, so I might as well sit through it and try to do whatever I can to help them out. Well, to make a long story short, we survived it just because I think that they were going to shut us down one day. Maybe it was bad weather in February, whatever happened, then they shut us down, we survived it. And the bank went public, and then we sold it, and everybody was very happy about it. Then I got on the board of another bank, and we sold it, and then I got on the board of another bank, but luckily that other bank was sold a month ago, so I sleep much better at night by not being on the board of a bank right now, because it's like the last thing I would want to do. It's impossible to run a business when the rules of the games are always changing. And the rules of the game in financial institutions are changing tremendously, so that, you know, if you're running the business good and if you were a good citizen and you make good loans, it doesn't matter because you all categorize in the same bad asset class. So shareholder value has gone down tremendously, and of course it has become a headache for everybody, the good and the bad and the ugly. But hopefully there is some sanity, and that we don't do some of the things that are being proposed to do. I don't know how, you know, people feel about marking assets in the market, but the way I look at it, if there is no market, there's no sense in marking it to zero, because every asset, it's got to be worth something, especially if it's functional, it's a living, and it's not just a paper shuffling kind of asset. But anyway, we are going to be in a long discovery period, as I call it, in finding out who's going to survive and who's not going to survive. Certainly, there's a lot of money being thrown at the problem, and hopefully some of it sticks. But these surveys about bank credit and credit standards and what the banks are doing is really history. I mean, something that the market looks at, we look at. But we know that banks have been shrinking their balance sheet for a long time. We stopped making, when I was on the bank board, we stopped making automotive floor plans loans about a year ago. Because one day we found out that, you know, we had a nice chunk of a loan, and somehow 350 cars disappeared, and we didn't know where they were. But, you know, there's nothing like looking at your assets every day and seeing where they are. And unfortunately, there's been a lot of fraud in the last few years. Things have been overvalued, overpriced, inflated values, and now we're in a cleanup period. And I think that in this cleanup period, everybody's going to be watching their credit, their borrowers a lot more carefully. I was at a meeting last week, and we were approving some loans, and, you know, somebody was having difficulty paying. I said, is anybody going there? Is the building you know, boarded up? Is somebody living there? I said, well, you know, in the old days, you know, we sort of counted on someone doing it for us, and we paid them. I said, okay, have you ever thought that maybe they were like in cahoots, and that you don't really know what you have, and maybe you should take a drive-by and check it out? So I think that we're going to be back to fundamentals, knowing where your assets are, and if they're actually as good as you think they are. Bank lending policies, yeah, for commercial real estate are very tight. I think I was talking to one of the regulators a month ago, and he was telling me that in New England, both commercial real estate as well as commercial C&I loans are likely to be seeing larger write-offs the quarter that we're in right now. I mentioned U.S. exports collapsing, and imports, of course, also going down. I think that, you know, a few words about inflation, deflation, and what the outlook may be like. And I think certainly when you have a declining GDP, it's going to create a bigger gap in terms of your output. It certainly makes it harder to increase prices. So certainly I think with a growing output gap, we'll see some deflationary pressures. But I think the Fed is willing to live with short-term deflationary pressures and probably deal with inflationary pressures down the road as not the worst of all evils. This is a little chart on that. I think deflation, okay, corporate profits, a little bit about corporate profits. I think it's very hard to anticipate corporate profits rising after tax profits rising when you have the kind of economic environment and inability to pass on higher prices that we are in. So I think certainly as far as P ratios are concerned, I think we have a overall market. We'll see some shrinkage. And I think here we are. P ratios, I think we're at the peak, you know, back around 2000, and of course we saw the dot-com collapse, the telecom collapse, and I think, you know, P ratios came down quite a bit. They level off quite a while, but you can see where we are right now. You know, we've come down quite a while. So one could say that there's a lot of value in the marketplace and things are cheap, but I think that not everything is created equal. So you really have to do your homework in terms of knowing what business you're investing in, how likely there's going to be restatement on the earnings that they provide you and how sustainable their business is. I think that cash is king, cash has been king. If you don't need money, the banks won't give it to you, but if you need it, the door is closed. So I think businesses have to be analyzed a little bit differently going forward. So I mentioned a little bit before about the opportunities that Treasury supply to debt is going to be huge. Government bailouts are certainly all the market support actions that the Fed has done in the last year and a half to create some fluid credit environment, some liquidity in the marketplace. I think they present a huge amount of opportunities for people that are in the business or want to be in that business. A lot more credit work. So I think that firming up those skills in analyzing workouts and restructuring the business is going to be a lot of value in the years ahead. There's a forecast for interest rates. Basically, the Fed going nowhere soon, leaving interest rates very low levels. I think that certainly out of this, it's going to be very difficult for people that live on a fixed income to generate the kind of fixed income that they want to preserve the principal in without taking credit risk. So Japan went through this for a number of years, and I think they're pretty much still going through it. I think Barbara's giving me signals. This is a little bit about interest rate economic forecast. And I think, I'll leave it open for questions right now. There's no sense of me wrapping up what I said already. I'll just leave it open for you all to raise some issues. So,
who has questions, Mrs. Ramirez? I'll start off with a question.
Yeah.
What you said before about how much one of the money is fixed in terms of the economic
Everybody bring it Barbara, right? You hear me now?
Hi. You mentioned about you hope some of the money sticks from the economic stimulus program. So, how confident or lack of confidence do you have in that it will really do some good to turn things around?
Well, I'm a perennial optimist, so I have to believe that it's going to work until it shows that it doesn't work. I don't think that we all know the details of how money is going to be funneled out. You know that some of this money is going to be wasted because that's usually, what happens. But what you just sort of hope for is that whatever money was going to be created that stabilized housing or stabilized jobs is going to go directly there. Now, we haven't seen the checks in the mail yet, and we don't know the details, but I'm sure that some of it is going to trickle down to places, whether it's the automotive industry or some local kind of infrastructure, job creation, or things that are going to get going in terms of job reskilling programs, what have you, that some of it is going to stick. Even if only a fraction of it sticks, it should help prevent things from getting worse. But, you're all going to be working, I'm going to be working. People ask me, when you're going to retire? I say, never is a good time, as long as I'm healthy. And besides, with what has happened with my portfolio, many of, your family's portfolio, we'll be working forever. So we have been in a principal preservation mode, but, preserving your principal is not enough to retire on. So I think that, your children, your grandchildren will be paying some of this debt. And I hope that you will have a lot of children because we're going to need a lot of that repayment in the years ahead. Yes? Yeah.
Question over here.
Okay.
Okay.
Yes, Ken. Yeah, go ahead.
What kind of suggestion would you think for us to invest currently so that we are put in a position that we can participate in the company's strengthening returns when reason replaces fear in the markets?
You're trying to ask me like what stocks to buy or something in this way?
What kind of
clue.
suggestion you have, like carefully selected what kind of portfolio you think we should go in?
Well, my own theory was that you diversity of investments globally, and you go where the consumer growth or consumer spending or the middle class is growing faster without the debt. So I always thought that Asia was a great place to invest in, just because it didn't seem to have, like Europe, a very big social, spending that took place, and also there was a very strong culture of savings. I still think that's the case. although the markets, over there also have been devastated quite a bit. So I'm a firm believer of investing globally, and I think investing in companies that globally do the right thing. I think that right now, the financial sector is very tainted in terms of what it has and what it has to deal with. So I really believe in companies that are doing things that the consumers want, whether it's a better quality of life. I always thought that, air quality, of water, everything that has to do with fundamental needs that people have should do very well in the long term. So, any utilities that provide that, any companies in the technology side that do that, those are things that people are going to want for a long time. So I don't know what they value at these days, but those are the kind of things that I would invest in. And some of those companies are like right around the zip code. There was a question here. Yes?
You spoke about the lack of saving in this country, and I was wondering if you've done some studies relating to the optimal, or I should say, the proper leverage versus the proper savings rate that we would think would be sustainable. We still have an economy that is strong, while we still cutting our dependence on foreign.
Yeah, I think that, if you look at, some countries that have been more sustainable in terms of financing their needs and being more insulated from outside forces, the savings rate is somewhere closer to 6 to 8%. So I think if we were to get to that level, which is like huge in terms of what it would contemplate in the decline in consumer spending, I think it certainly will be a much more comfortable level to get to. But, a savings rate is all well and good when everything else is normal. And, debt to GDP or those kind of things are all well and good when, you don't have problems. But, Japan went through a lot of problems in the 90s, and their spending was many times the size of the GDP. So, if we're able to get out of this and come out with, 3 to 5 years from now with an economy that's, going back and growing at 3%, but hopefully we remember the mistakes that we made, in the past in terms of creating too many credit instruments and inflating that credit bubble. We learn from it. But the truth is that we've gone through this before in different shapes or forms. We, back in the 99, 98, everybody, the market was giving money to companies that were losing money every month, and the more money you lost, the more money you got. It was like a stupid philosophy, but it lasted for about 3 years, and then the whole dot-com blew up. And then, of course, we went through the telecoms, and telecom companies lost 1.3 trillion of debt that they had outstanding. In 2001 and 2002, people don't really remember it, but, WorldCom and Enron, many companies got blown up because of, poor judgment, and the market, didn't properly assess them. So I think that, a savings rate of 6% seems high for the U.S. For other countries, not that high. But I think that if you have a savings rate, well, in that range of 6 to 8%, it makes you more sustainable in terms of being able to finance your needs. And I think, in the deleveraging process that we're in right now, we're probably going to get to that point in the next few years.
I have another question for you related to nationalization of the bank. You speak of take the proposition that for reference to maybe nationalizing the bank.
Yeah, in the headline last night, my husband came back and put the car away, and he goes, he's always like a jokester, but sometimes I don't get his jokes, and I'm like, So he said, well, Citibank was nationalized, your stock now is worth 30 cents. I said, okay, thank you very much. Don't give me any more good news for the night. But anyway, that was not true, of course. But, all this talks about nationalization and whatever negotiations are taking place in terms of, what the government would own, at what level, what preference they would have over other investors. Certainly, it's sort of been priced into, some of the stocks already. Certainly, I think that the private sector generally is better in, running companies than, you don't want to do this. I think that in some countries it has been done, but, the banking sector was not as big as it is here, was not as big as a country. I think if you can manage it in a very kind of tight environment, to change things drastically, it works better than I think if you were to do it here. So I think what they're trying to negotiate is what ownership you have larger ownership by the government, but when you think of what's happened already in terms of mandating the cap on salaries of CEOs, mandating, the restructuring or modification of mortgages, mandating like a lot of other things that, money doesn't come without strings attached from anyone. So I think that, they have a lot of strings that, hold back on what they could do. And I think that, total ownership of those two banks that you mentioned would be the wrong thing to do because they are so massive, Anyone, when you're running like an institution of that size, anyone that thinks that the CEO knows everything, forget about it, they're lying because they have no idea. The institutions get so large that they're impossible to manage and to know where all the risks are. A few years ago, one of the institutions that no longer existed has been absorbed by somebody else. They came over to us and they said, well, you're a money manager, why don't you manage the warehousing of these loans that we're going to put in CDO? You don't have to do anything, you're just going to get a fee. And I said, well, who's going to do the credit work? Oh, don't worry about it, we do the credit work. You don't have to worry about anything, you just get a fee. And I said, no, when something sounds too good to be true, it's too good to be true. Now, if I had done that, I would have made a lot of money, but probably, my name would not be any longer credible. So I think that you have to be careful in terms of, whatever you do in life, who you want to be associated with, and to be just, have good gut instincts. In early July, I had someone visiting my office about, this great money manager that had a formula, and he was giving great returns, 3%, all the money was in treasury bills, and he did something only at the end of the quarter, and it was a formula that nobody knew about with only 50 stocks, and they would greatly appreciate if I could introduce them to my institutional clients so that they could raise money from them. And I said, wait a second, why should I do that? I have no idea what this guy's doing. And then, of course, lo and behold, the name is plastered all over the media in December, and if I had done that, then, my reputation would be over and gone with. So I think that what you have to be careful about is things that sound to be good, too good to be true, that are indeed too good to be true. And when somebody explained to me a year ago what a Square CDO was, I was like flabbergasted. I said, why would anybody do something like that? That is such a criminal thing to do. But anyway, those things were done, and people bought them. And of course, now people got to figure out how much they could write off every quarter. And I think the problem with all this government intervention has been is that each time they got another 10 billion, then they were able to write off 10 billion. So we don't know how much there is left to be written off, because nobody knows at those large institutions what they bought, what it was worth. So unless they figure out how much they have to write off, it's going to be like dumping good money into bad money. But unfortunately, somebody's going to have to go in. Maybe it's Treasury Secretary and team people that go in and get to the bottom of it and say, well, all this stuff is worth nothing. You're carrying it at too much higher value, and this is what we need to do. And that's the only way it's going to get done, because the internal culture is not going to come out with the truth very quickly. Yes. Yes.
The lazy Harris might say, government, don't do anything. Let GM go under, let Chrysler go under, let Citibank go under, have them redirect their assets to something else, and let's not build cars, let's figure out what we do well, and do that. That's what a lazy Harris might say. And the government getting involved, we're going to have this big debt eventually, and that has to be paid, and a lot of our GMP is going to be going towards repaying our debt. What are your thoughts on that?
It's really hard, because I don't know if everybody with depression,
You were
anybody heard it? No, you didn't have the question. Okay. Where's the mic? Can you pass it down?
I'll talk louder if that's better. Okay, I get nervous with these.
No, don't worry about it. No friends here.
A lazy Ferris might say that let the government do nothing, and let GM go under, let Chrysler and Citibank go under. And what will happen is those people who are working there and the assets from those companies, if there's anything left, will be redirected to something else. Rather than Americans build cars, which a lot of people say aren't any good, let's build something else. Let's start over again. And with the government helping out, we're going to have a big debt, and eventually that debt's going to have to be repaid. And who's going to pay it back? And what percent of our GNP is going towards just getting out of debt rather than building up the economy? Not that I believe one way or the other, just wondering what your opinion is on it.
Well, I think that, you know, when it comes to an industry that, you know, has had problems, I mean, if you think back, we had the airline industry went through bankruptcy, right? They got fixed up, you know. I remember I used to have USDS stock at $70. It was worth nothing. Then after a few years, after they went into bankruptcy, they did an IPO, went public again. So I think that, you know, we've seen a lot of times in history where there is a lot of stress in, you know, one sector or another. The companies are allowed to go into bankruptcy and restructure themselves. I think that, you know, what lost that, I think, in those periods is a unionized labor, which they had to give up a lot of, you know, the pensions, benefits, whatever they had. I think that, you know, there is a place for the U.S. to make cars, where the cost that we have, the legacy cost with pensions and other, you know, things that these companies have to pay for, sooner or later, either, you know, the companies are able to have the, you know, the wherewithal to rebuild themselves or change ownership or whoever, you know, survives. I mean, they're not going to go out of business. Maybe the ownership changes or some of those assets, some of the pieces of the companies are owned by somebody else, like, you know, a foreign company. But I don't think that, you know, the manufacturing of automobiles, you know, in the U.S. has changed. I mean, when you think of it 25, 30 years ago, we didn't have, you know, foreign companies making cars in the U.S. So, you know, we've had that for many years already. Those people may end up working at other companies. I mean, it's very easy to sort of be academic about it. You know, those resources will get used up some other place. But when you're talking about lives in cities and people where they live and their families, it's not that easy to make, you know, that decision to, you know, let them all go bankrupt at the same time. It just doesn't work because, you know, it just pushes more on the financing of, you know, the pensions by the Treasury. I mean, the pension guarantee, the insurance company, for all intents and purposes, doesn't have enough money to pay for that. So if those companies were to go bankrupt, it would just push us a lot more money that the pension guarantee would have to pay for, and that's going to come probably from the U.S. Treasury. After all, if you got money from the mortgage industry, the banking industry, then you got to take care of the pensions too. So I think it's a matter of time that they get some fresh ownership that's going to change things, maybe in a way that you know, the unions don't like it. But I think there's going to be a lot of give and take. There was something floated last week that I heard about maybe the employees own the unions owning 75% of the companies. I don't know if that works, but you know, United Airlines I think did it. Some of the other airlines did it. I think they're going to have to come with some, you know, out of the box kind of ideas for those companies to survive. But maybe for the employees that have more stake in terms of their jobs and pensions, to take more ownership in it to make it fixable. But you know, it's really amazing. You know, I was watching the testimonies in Washington when they were asking, you know, how did you get down here? And the three guys looked at each other. It's like nobody wants to fess up to the fact that they went down on a private plane. Well, it's like, hello? It's like, you know, I think that management for a number of years, especially in public companies, they've operated them as it's other people's money and, you know, grossly overpaid. And I think that this shake-up is bringing things to a more, you know, level that makes sense. So I think that, you know, the shake-up is coming from the top and, you know, from all sides, and especially I think in the financial and in the automotive industry and anyone else that is going to Washington to take money.